Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Brian Stutland, Managing Partner at Equity Armor Investments, as well as Mike Khouw, CNBC contributor and YieldMax strategist at YieldMax ETFs. We're here to discuss Fed policy, emerging themes from big tech earnings, and the impact of AI on cybersecurity. Let's kick it off and discuss the Fed. And Mike, of course, the December rate cut is not a foregone conclusion. There's a number of things at play here, right? There's no evidence of deterioration in the broader labor market. Economic indicators such as business investment and retail sales are still fairly healthy. You've got the top 10% enjoying their gains in the stock market and that K-shaped recovery. And this is a tricky balance for the Fed, especially with the government shutdown reducing visibility even further.
Yeah, I think that's right. I mean, what you were doing there was basically quoting exactly what Jerome Powell was saying earlier this week, when those were the words he used. It's not a foregone conclusion, which was interesting because, of course, the Fed fund futures market was actually saying that it was effectively a foregone conclusion. So this contradicted actually what the market's expectations were. I think what's interesting is that if we take a look at the Fed's preferred measure of inflation, which is PCE, one of the things that we can see is that while it is considerably lower than it was in the post-pandemic sort of peak, almost near, well, I don't know if hyperinflation is the right way to describe it, but we had the highest inflation in 4 decades in 2021 and 2022. The problem is the trend here. What we would like to see is that this would continue to trend lower and ultimately fall below 2%. And if we look at this chart, I realize that vertical axis is a little hard to read, but we're well above 2. And in fact, it feels a little bit like the former ceiling for the rate of inflation as measured by PCE has suddenly become a floor. So that's part of the problem. And I think another part of the problem is that we do have some cracks on the consumer side. We've discussed this previously. We saw some more evidence of that this week, though. Chipotle was just, they had some very disappointing earnings. And one of the things they indicated was that consumers are struggling. And that's the kind of thing that you combine that with, the layoffs that were announced. They're very public, but they haven't permeated the entire labor force. But the layoffs from UPS, the layoffs from Amazon, we actually had some from Target as well. Plus, Target said that they were not going to be filling 800 open positions on top of the 1,000 that they're going to be laying off. You put these things together, and that can hurt consumer confidence even further, even if in the grand scheme of the labor market, those specific changes aren't really that meaningful.
Yeah. And Brian, I'd like to get your thoughts on this as well from a volatility perspective. I mean, if you take a look at the market today, it's probably largely based on earnings from last night, but it wasn't even a full session and it's recovered at this point.
Yeah, it has. Obviously the day after Fed speak and give their interest rate view, we saw the markets yesterday really kind of tank. Some of that driven by Meta, which had earnings that were maybe not so good as at least the street thought that, as the stock was down over 10%. But now we're seeing it back recover again. Amazon earnings came out last night. Those were fairly decent. Stocks up fairly large today, up about 10%. So certainly that's kind of led a charge in the rally. Market's kind of drifting around here, really. When you look at a technical perspective on things, the markets really kind of took off from the S&P 6,800 or Nasdaq 25,000. Both those markets moving significantly higher off those. And it's not unusual to kind of take a breath. All those momentum traders that were sort of riding the high up are now sort of wishy-washy here, taking some profits. And so there could be a little bit of a carpet shakeout. And then you mentioned about the volatility space. Anytime we've really seen the VIX get down to 15 or 16 or so this year, the market's kind of seen a top, right? And volatility traders come in looking for some cheap option plays to own, and that protection tends to come to fruition. We sort of get a carpet shakeout, a little VIX pop following that. So for us, that mantra has really been a buy indicator. We see the VIX around 15, 16 for clients. We've been looking to sort of own some level or up some level of protection at that area. So our models have kind of triggered that. And I think we're going to continue to see that. Mike points out the consumer and whether that's healthy and can the Fed keep really lowering rates in the face of PCE numbers kind of sliding higher. Remember, in the 70s, we saw inflation come back down, and there was actually 3 waves of serious inflation back up, where it kind of got stuck in the mud. It got back down to a decent level, but then turned the other way higher. So are we in for another 3? Like, so do we have 2 more waves of inflation to come before it all kind of breaks or not? There's definitely some concerns, and I think that's why the VIX kind of has a bottom to it.
Yeah. Well, Brian, let's stick with the earnings theme for a moment here and what we saw this week. And I think one of the themes that emerged was AI investment scrutiny. Investors are continuing to look at the high spending on AI. They're questioning whether the heavy investments by big tech will deliver adequate returns. So measuring returns, spend, and adoption at this point is quite challenging.
Yeah, it is. And people are starting to get a little jittery, and they want to see some profits starting to come to fruition. We're seeing valuations in the S&P so high right now that they want to see some of this growth target start to be hit. In Amazon's earning, they talked about the cloud computing being very successful last quarter, a reason for their sort of boom in earnings play. I think more people want to see some level of that AI play start to come to fruition here, and that with what the spend is like, that you're actually starting to see some earnings clarity. We're now a couple of years into the whole AI, and people are starting to look and need results given the high valuations in the market.
Yeah. And Mike, you had brought up, job cuts that we saw this week in particular, and even still trying to figure that out. Is it a result of AI? Is it possibly there was overhiring through the COVID period and so forth? It still feels like it's a bit early to discern exactly what those reasons were.
Yeah, I think Amazon was kind of giving us some clues. I mean, they suggested that it's a strategic repositioning, if you will, of where they're going to allocate. And they, first of all, they haven't had any kind of major job cuts over there for a while. So I think this was, if we maybe call it a cleanup, if you will. I mean, they just basically had sort of held off. There's a term that they call job hoarding, where essentially corporations not exactly sure how they're going to move through a transitionary period. Perhaps you have productivity enhancements that come from AI, but they hang on to jobs that might be better eliminated for a little while. And I think we're starting to see a bit of a flush on that score. And Brian was talking about valuations. It's true, the S&P's valuations, its turn relative to trailing earnings and also to forward earnings is getting quite high now. And this is a great chart that we have up here. JP Morgan put out a chart that looks a lot like this one. And what this chart is a regression of 10-year forward returns relative to the trailing 12-month price to earnings for the S&P. And what you can see is once you get to about 23 times earnings or so, the forward total returns annualized turn out to be pretty weak. And we're actually a little bit above that now. We're probably closer to 26 times trailing 12-month earnings. The interesting thing is, though, that even though the market is expensive, and even though the largest constituents of it have gotten very valuable, what's peculiar is that a lot of those businesses are not amongst the most expensive ones. When you take a look at a company like Amazon, Amazon's trading at a market multiple with better than market top and bottom line growth. Same thing is true for NVIDIA, right? NVIDIA's trading only a couple turns away from where the S&P is, but its growth rate is nothing like it. And in the case of Meta, the feedback that we got, I think, from investors, and the reason that the stock bounced back was that they were unhappy with their CapEx numbers. It wasn't the earnings. Actually, the earnings came out, I think, pretty decent. It was actually on or just above consensus, but it's just they're doubling down on investing in this space. So, and that's an elective thing to do, right? So if you start to see margins get compressed because there's pressure on the top line or there's pressure on net income margins, that's problematic for stocks. But if the reason is because management is making conscious decisions to invest, I don't think that's the thing to get as concerned about.
Yeah. And, Mike, to wrap up our Cybersecurity Awareness Month coverage, October 31st, not only Halloween, but also this will be our last segment focusing on that. I want to talk about measuring the impact of AI in cybersecurity because it goes beyond traditional metrics such as the number of prevented breaches, detection rate, time to respond. You have to be able to adapt to account for AI contributions. So when you think about new metrics like model accuracy, false positive negative rates, adaptability to emerging threats, that's also important. But going back to earnings, measuring the financial impacts such as reduction in breach costs, operational efficiency gains, resource saving, that helps determine ROI for AI-enabled cybersecurity. However, quantifying these benefits are quite complex, and they're also context dependent, as is everything with AI.
Yeah, I mean, I think what's interesting here is that the struggle for investors is we try to handicap how we discount those benefits. We also have to figure out how we handicap and discount the threats. That is to say that AI is a double-edged sword. And for friendly actors, it's a powerful tool. But it is also a powerful tool for malevolent actors as well. And I think you were talking about this before we went live, which is that we can expect that there's kind of an arms race going on here, that technological improvements end up getting deployed by, the good and the bad. So from my perspective, I think it's something we really need to keep a very close eye on. I believe that on balance, this is a net positive, but I'm also open to the idea that, we could also see some threats that we haven't experienced before simply because those actors have been empowered by the technology they now have at their fingertips.
Yeah, I mean, they certainly do. There's actually something called cybercrime as a service. So when you think about SaaS, it's actually being positioned as a service now with the bad actors, which, adds to the complexity because they're so well funded when they're teaming up with nation states, as an example. Brian, to wrap up here, I'd like to get your thoughts on the space as well.
Yeah, I think when you're looking at the investment side of it, I mean, we've talked about this before. I look at cybersecurity investment on that side as almost a value play to technology. You're not going to probably see valuations rise to the degree in the expansion that we're seeing in a lot of the other AI names, but the industry as a whole is expanding and valuations are reasonable. So we hold it in our portfolio. I think we brought up before in the past two ETFs that are interesting, Hack and iHack. The difference really between the two is Hack has as a top holding Broadcom in it. So if you like that one, maybe that's an ETF. That's one that you want to buy. If you don't, iHack is probably the other. Those are the two that we like to take a look at. So in this space, I think it's got to sit in a portfolio. It continues to expand as we see AI continue to grow out. The ever importance of cybersecurity behind just the technology of AI itself is going to be so crucial. So this is here to stay. This is something to keep an eye on and an area that we're going to position in our portfolio.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.